All right, guys, so today we are going to be talking about the infamous DSCR loan. So we're going to be explaining what this loan is, who it helps, and why it is actually one of the best loans, one of my favorite loans, and one of the loans that we are well versed in and experienced in and we can help you on. What it stands for, first off, because it's important to know that. Debt service coverage ratio. And what does that mean? It just means that when you buy the property, it's going to analyze if rents from that property would cover the mortgage payment. So first off, let's talk a little bit about how it's calculated and what they look for. So how is it calculated? The target is 1.0. So let me give you an example of this. If rent is $2,000 and your PITI, principal, interest, taxes, insurance, the whole thing, is $1,800, then you would be at a 1.11 ratio, meaning you're above the 1.0 target, meaning this property would be checkmark approved and good for a DSCR loan. Now, there are other DSCR programs that allow you to go less than this 1.0 ratio, but I'm a real estate investor. I've got about 30 doors myself, and I can clearly tell you that if it's less than a 1.0 ratio, you probably shouldn't be buying it in the first place as a rental property. Like the minimum, and it should at least cover everything, because you're going to have repairs and other things that pop up in these properties. And if you're stroking an extra payment every single month, that property is probably not a great deal. But there are programs that allow you to go to 0.75 of that number. So similar, right? You know, if the mortgage was higher than $2,000, then you'd be below the 1.0, which you can still qualify for. Now, who are these loans for? I mean, self-employed people buying a rental property, they're mainly investor loans. So for investors, they're great for a BRRRR strategy. Not sure if you guys have heard much about that, right? It's like buying, rehabbing, renting out essentially is the BRRRR strategy, and there's more in there, but this is the main thing. When you're doing the BRRRR strategy, you're buying a dilapidated property, you're doing the repairs, and there's some amazing DSCR lenders. Let's say you complete those repairs within 2 months. Well, conventional seasoning, as we know, doesn't allow you to pull any equity out of the property for a year. It used to be 6 months. It changed to a year in the last, year, I think. Pretty recently that change has been made. But a DSCR loan actually allows you to get all of your funds out of the property day one. So if you're a real estate investor, maybe you purchased it cash, maybe you've gotten private money, maybe you're financing the repairs, maybe you're paying for the repairs out of pocket or out of your own cash, and you want that money back. The beautiful thing about the DSCR loan is we can show invoices, we can show receipts, and on day one of buying the property, day one, I mean, not that you'd ever get the repairs completed that quick, you'd be able to pull that money back out of the property, not leaving it in there, because as an investor buying the dilapidated property, I know how the game works. You're wanting to move that money into another property and trying not to leave it locked up. So how do lenders look at these loans? Well, they're going to do, it's very simple actually. They're not going to look at, pay stubs and W-2s and tax returns and the whole nine, the whole traditional FHA, conventional VA look. They're going to look at just a couple different things. An appraisal with the market rent analysis, which is what? How they're going to calculate this. Mortgage payments $2,000. Rental analysis says this home will rent for $2,200. Boom, you've made it. Now, maybe a rental analysis comes in lower, then you could have a little bit of maybe some problems in underwriting or have to go to that different program. So if the ratio is less as well, some changes to the program will be made typically, and the interest rates are going to be higher because that's going to be a higher risk DSCR loan. So just some things to look at. The other thing they're going to look at again is the DSCR ratio, which we spoke about that. They're going to look at your experience level. This makes a difference on how much they'll lend you. So a lot of lenders will say, hey, you got to put 20% down on your first DSCR loan, right? Or if you have a high level of experience, and this works with hard money and private money loans too, you can sometimes get better financing, right? Hard money loans will actually give you, and this is crazy for people that are not in the real estate game to really understand this, you have to do it. When I first got into it, super scared, like didn't think it would work, like thought people were crazy for leveraging and doing this. But here's what we do as an investor. I'm going to give you some inside tricks right here. What we do is we get once we have the experience level and we have private money investors. So a private money investor would be like, Bob Joe, trust me, and they're going to tie a lien to the property. They're going to give me the money to buy the property and rehab it because they know that I'm going to value add and create enough equity that I will be able to get their money back out. So what we'll do is we'll get 100% financing sometimes. So I'll give you an example. I'll just use like a working example. I'm buying a property in Clovis and triplex for $295. Okay, this property, when it's all said and done, is going to be anywhere between $630,000 to $700,000 in value. I got to put about $100,000 into it. I'm going to be all in at $400,000. My private money lender, who's done many loans for me and has seen that I perform and get their money back, they lent me the full $400,000, which I'm using to do the rehab, which is going to take about 2 to 3 months. And then boom, we're going to refinance and we're going to pull that equity out for them because we have a lien on it, so we can do a rate and term refinance. We're going to get our repair money back and we're going to pay back our private money lenders. Now, when you're going the DSCR route, you're kind of going more of like a traditional lender. Of course, it's an out-of-the-box lender that does it on the rental analysis, things of that nature. So they are going to have down payment requirements. They are going to have equity requirements that like a private money lender wouldn't have. But that's a little bit of the game, and we'll have more videos on like how we do that and how I do that and how investors around me do it. But that's just like a little snippet of that. The other thing they're going to look at is liquidity and reserves. They want to make sure that if shit hits the fan, because if you have rentals, you know shit will hit the fan. And they want to make sure that you have the liquidity and reserves to handle it. They want to make sure that you're in a financial position that if, let's say, the AC goes out or a water heater goes out or something goes out, that you're going to be able to handle that. Or maybe you have a problematic tenant not paying rent. You got to evict them. In California, it's hard to evict somebody. It could take 60, 90 days. You got to send a sheriff out there. You got to do a lockout. You got to do a lot of different things. So they want to make sure that you have the liquidity and reserves to handle that and withstand that. And the last thing is going to be property type. So the interest rate can vary on this. So if we're a single family residence, the interest rate and the down payment may be less than if you're on a triplex or a fourplex, 3 or 4 unit property. So guys, in a nutshell, this is what a DSCR ratio loan is. It's really a great loan for investors. In synopsis, it's used to purchase properties without showing W-2s, pay stubs, things of that nature. And one key thing that I left out that's really important is Fannie Mae conventional loans only usually allow, well, not usually, they only allow 10 mortgages, right? So if you're an investor doing these value adds and refinancing into a conventional mortgage and you get to 10, how do you scale your portfolio more? DSCR loans are the answer because these companies are basically private companies lending you the money, and some of them have, some of them will say, hey, you can have 15 loans. Some of them will say, hey, you can have 10 loans with us. Some of them will say you can have 20 loans. So this allows you to scale your portfolio, and to be honest, the rates are actually incredibly comparable with conventional rates sometimes. The other thing I wanted to talk about is prepayments. So when you do a DSCR loan, you will have the option to choose a prepayment penalty. So you can do 0, right? You could sell the place right away if you want to. You can do 1 year, you can do 2 years, you can do 3 years. Every year that you add, the interest rate is going to get a little bit better. Where rates are right now, it's always my professional recommendation to do like a 1-year prepayment penalty because you're probably not going to refinance or sell before 1 year, and rates will go down. So if rates are high right now and then you have the opportunity to refinance, but you lock yourself into a 5-year prepayment penalty, guess what happens in year 1 or 2? You're going to refinance and you're going to have to pay the difference in interest because that lender's not going to let you off the hook for that 5-year prepayment penalty. So I always recommend, 1 year right now with rates being where they're at because things will come down and you'll have an opportunity to hopefully refinance that into a more permanent interest rate, which again, as you're building your rental portfolio, just makes all the difference, right? We're raising rents every year, and at the same time, when rates come down, we're going to refinance. So we're just creating that value add and adding cash flow to the portfolio. So this, in a nutshell, is our DSCR loans. If you guys have any questions on this, please feel free to reach out to me. I'm an open book. I'm more than happy to help you answer any questions that you have. And let's get you started on your next DSCR loan. Give me a call.